Hi everybody, come on in, make yourself comfortable. We'll get started in about a minute. Hi everybody, thanks for joining us. We're going to kick things off in about 30 seconds, so come on in, make yourself comfortable. All right, we'll get started. Welcome to our first webinar for 2023. We're wheeling out the big guns for today's discussion, focusing on the practical implications of the economic outlook for 2023. My name is Jeff Thurecht. I'll be the host for today. I'm a director at Evalesco and Australian Advice Network, and I'm very excited to be joined by my very insightful business partner, Marshall Brentnall. Welcome back, Marsh.
Thank you, Jeff.
As well as the very talented and knowledgeable Michael O'Day, who is head of multi-asset at Perpetual and responsible for managing hundreds of millions of our clients' money. So thank you for joining us, Michael, to share your insights as well.
Thanks a lot, Jeff.
So on the screen there, you can see a little bit about more of Michael's background as well. So just before we get into today's conversation, just like to let you know that at home, you are on mute and your video is turned off, so we can't see or hear you. So feel free to move around and talk amongst yourselves at home. We do encourage you to ask questions though on the way through. So click on the Q&A box at the bottom of the screen there, type in your questions. I'll be able to see those and we'll either pass them on during the conversation to Marshall or Michael, or we'll come back to them time permitting at the end. If we run out of time, we'll come back to you after the session. Most of our conversation today will be about general investment markets and concepts with some specific examples. So I'm just going to provide you with this general advice disclaimer to let you know that even though most people on the call today are clients of Evalesco or AAN, right now we're not considering your personal financial situation or goals. So if you'd like to discuss, so this webinar is not personal advice, and if you'd like to discuss it further, please contact your advisor or get in touch with one of us and we'll go through it with you. So the format today, Michael's going to take us through some excellent slides and charts about the broader economic and market positioning and the outlook. Marshall's going to chime in with some insights. I'll probably ask some questions and we hope we'll get some questions at home as well. And we'll both share some thoughts, on what it means for investment portfolios for this year. So over to you to kick us off, Michael.
Thanks a lot, Jeff, and good afternoon, everyone. I guess a good place to start is to talk about last year. And last year, investors were increasingly concerned about the possibility of a global recession. Europe was facing an energy crisis with dependence on Russian gas, and the US yield curve was deeply inverted, and that's usually a pretty clear signal that a recession is coming sort of in the next 6 months. But then the market began to believe it might be possible to avoid a recession. Europe experienced a much milder winter than it usually experiences, and so that took the pressure off the energy crisis. And governments also transferred a lot of money to individuals and corporates to help them with their electricity bills. And the US economy is showing a great deal of resilience. Then the market saw the peak of inflation and started to get excited that it would come down sufficiently to enable the Federal Reserve to start cutting rates at the end of 23. And today there's very few signs of a slowdown in the economy or the labour market outside of Australia. And while an economy with strong momentum sounds pretty good from a corporate earnings perspective, if inflation gets stuck above a 4% level, it means that cash rates might need to go higher and stay higher for a longer period of time. So I think given how much is resting on the shoulders of where inflation's going, I think that's a pretty good starting point for us. On the positive side, it's pretty clear that inflation has peaked, and you can see this here, and this is headline inflation in the US broken down by the components. But the key is not that inflation has peaked. The key is the path back to 2%, which is, sorry about that, I've gone forwards, there we go. The key is getting back to a 2% target, which is the Federal Reserve's target. And over the past 6 months, US headline inflation has come back to about 6.5%, and no one thought that it was going to stay at around 9%. But a lot of that retreat that we've seen in inflation has been commodity prices, bringing down the cost of energy and the cost of goods prices. And that's also been a result as supply chains have been able to realign themselves due to the reopening after the COVID lockdowns. Food prices, on the other hand, were pretty much unchanged, and core services, which is in that gold bar, that's continued to rise. And core services is really what the central banks are concerned about, because they can get quite sticky in terms of their inflation input, and they really only get dislodged if there's a recession. As you can see in the grey bars there, that's been the previous US recessions, and the impact on core services inflation is there. So to me,
what would fit into core services, Michael? What's involved in that?
Travel industry, any sort of services as opposed to goods that are sold to people. So, yeah, and services sector makes up the majority of the economy. So, education, all of those types of things are services, or consulting services, etc. So it's a very important part of the economy, and it can get sticky. And what the central bank is trying to avoid is a de-anchoring of inflation expectations. They want people to think that inflation is going to go back to 2%, not that it's going to stay high. Otherwise, then it feeds into wage expectations, and then it can be this, circular reference back into broader inflation. So the problem at the moment is really that the market's expecting inflation to come back to 2% without a recession. And they're also expecting the Federal Reserve is going to be able to ease rates at the end of the year. I just don't think all of those things are possible. And if you look at what's happened more recently, inflation started to miss on the high side in 2021, and central banks dismissed that initially as being transitory. They said, well, look, we've had factories that have been locked down. That's created sort of an imbalance in supply versus the demand for those goods. And so that will sort itself out as economies reopen, and as China reopens. And then, 2021 went by, and in 2022, they were getting quite concerned about this feedback mechanism of inflation. So the Federal Reserve in particular got quite busy during last year, and you can see on the left-hand side, that's the average hikes that they made last year relative to previous hiking cycles. So they almost did double the pace of hiking at every meeting than they'd traditionally have done. You can see on the right-hand side, that's what it looks like in terms of the Fed fund rate over time. And, it's been a steep incline. But given where economic conditions are today, there's what's called a Taylor rule, and it's been used as a bit of a guide as to what would be optimal sort of monetary policy settings. That suggests that they're still accommodative in a way. That the Taylor rule would suggest the Fed funds rate needs to be at 9% to bring inflation back under control today. Now, that's nowhere near where market expectations are of the terminal rate for the Federal Reserve. The market's expecting between 5 and 5.5%, and I think that's probably more accurate than the Taylor rule. But at the moment, inflation's still at 6.5%, so that's still a negative real rate. That Fed funds rate, the cash rate, is still lower than inflation at the moment. So inflation needs to come down in order for there to be a positive real rate, which helps to tighten conditions.
Okay, so if we just on that, the interest rate increases. So the Australian market has experienced reasonably similar, maybe not quite as steep in some areas, but interest rates here have obviously increased a fair bit since this time last year. What has been the impact of that, Marsh, on, I guess, at a personal level and what we're seeing for clients?
Yeah, we look at it, I guess, if I think about the different types of clients that we work with, we have quite a number of retiree clients and also accumulated clients. So the retiree clients typically, approximately a third of their portfolio will be in defensive strategies, which will be cash, bonds, term deposits. And for a couple of years now, that part of their portfolio has had, really little to no earnings. Historically, working cash in client portfolios the last couple of years has probably been earning 0.2% if you're lucky. Term deposits might have been 0.5%, bonds either side of that. In the last 12 months, we've seen some dramatic changes in that area. Working cash, you're now sort of sitting at 2.5% to 3%. Which is a market change from where we were 12 months ago. What it's also meant is that as the interest rates continue to move forward, we keep using, shorter term deposit strategies so that the client can participate in that journey. And also the bond strategies are typically what they would call a floating rate or not a long duration strategy. So as interest rates continue to move, our clients are able to participate in that journey. So, where we're at the moment is if we're starting to think that rates, the increases might slow, do we start to change that fixed income mix? So that's some of the conversations that at an investment committee level, we're certainly having with Michael and some of his peers to seek their counsel there. For our accumulated clients that have got home loans, typically they're not carrying large levels of unproductive cash. So they might have anywhere from 3 to 12 months worth of money on hand in offset accounts. So we're certainly making sure that they're using multiple offset accounts at the same time. So every account has a purpose. And Jules and Christy, every 6 to 12 months, depending on the lender, they're fairly aggressively seeking to review those loans to make sure that we're doing everything we can to bring down the cost of those loans.
Yep. And we'll touch on that a little bit later in regards to fixed rates and the impact there. Thanks, Marsh. Back to you, Michael.
There's been a lot of contradictory economic data out there, particularly between the hard data, which is trailing data on GDP growth, employment data, retail sales, all of that's been really, really strong, versus the so-called soft data, which is, it's a leading indicator of where the economy might go. And this soft data is surveys. So they ask CEOs how confident they're feeling, what their intentions are. They ask households the same sort of questions. And the survey data has all been pointing basically to a downturn, which you can see in these charts here. So the question has to be, are the surveys too pessimistic? Are people too pessimistic given the strength of the economy? And that's certainly been the case historically, that these surveys can get too pessimistic. But typically, when it's worked out better than the surveys have predicted, it's typically been when the central bank has been able to ease and reduce the cash rate to provide liquidity to the market. That's not the case at this point in time, with inflation still well above target levels. So that's something to keep in mind. And if we move forward, I think the other thing to keep in mind is just how different today's environment is to what we experienced 1 to 2 years ago. If I think back to the GFC, the scene was set for very weak economic growth as the economy was recovering from the GFC. But that meant that inflation was undershooting targeted levels for central banks, and that they could keep policy settings or interest rates really, really low. And in fact, they embarked on quantitative easing programs where the central bank was buying government bonds and helping to keep interest rates really low for government borrowing as well. So effective was this that we ended up with about $19 trillion of government bonds trading at negative yields. So if an investor bought that bond trading on a negative yield, they were guaranteeing losses if they held it through to maturity. Now, some strange things happened as a result of that. If you're guaranteed to lose money in government bonds, it really encourages some speculation and risk-taking. And one of those things that happened, which was quite strange, with the benefit of hindsight, is that in 2019, a Danish bank offered a mortgage product where they were paying a negative interest rate to customers who were entitled to this mortgage. They still have to pass credit tests, but the principal on their mortgage would reduce by 0.5% each year for 10 years. So that's unheard of and almost crazy. It's free money in a sense.
Yeah.
And the second thing that happened, which I'm sure people will remember, the NFTs, the non-fungible tokens, and also cryptocurrencies. I mean, they took off. And I still can't explain why they took off, but this crypto punk NFT was one of the most expensive ones that were traded. It's horrendous, but it sold for something like $12 million. It's, that kind of perverse things happen when interest rates are really low for a really long period of time. And not to mention that asset prices across the board, including equities, got to some pretty expensive levels. So an adjustment to higher interest rates, obviously came with some pain last year, but I don't think we're through all of that adjustment process. And so that could continue to flow through. And the reason that it's going to continue to flow through, and in an Australian context, is that there is going to be a move, of resetting mortgage rates for those that have been on fixed rates. And some of those fixed rates were below 2%, and some of those will adjust upwards to close to 6%. And the RBA has noted that about half of all fixed rate loans outstanding are going to have to roll onto new interest rates. And that's a big problem in terms of the headwind for incomes this year for households. For those that have mortgages, it could be an 8% hit to income this year. And it's going to be the steepest uplift in serviceability payments on record. Westpac's been in the press talking about this as well. They used to have a serviceability test of about 2% buffer over the prevailing mortgage rate, and then a 7% floor in terms of you've got to be able to withstand a 7% interest rate. In 2019, that 7% floor was axed, and the buffer was increased to 2.5% to 3%. And Westpac's been out there saying that half of its $471 billion mortgage book is going to exceed that buffer in terms of this change in interest rate. So they haven't tested for that level. And in fact, the other issue is that the peak rate of the RBA cash rate is likely to be around 4.1%. And what that means is that the average variable home loan interest rate will be about 7%, according to Morgan Stanley. So this is a big shock, I think, in terms of income, and the RBA is not finished yet in terms of its rate hikes either. And we are feeling it as Australians more directly than the US, because they have predominantly fixed rate mortgages and we have predominantly variable rate mortgages, and our fixed rates are also rolling onto higher interest rates. So that's something to be mindful, I think, of this year and how the economy is going to go. We have bought fixed income and Australian government bonds as a result of that, in case this acts to slow the Australian economy at a rapid pace. And last year, we held zero fixed income in the portfolio, which was up until about July, which was incredibly beneficial because fixed income was a very poor performer last year, and it had one of its worst ever performances on record.
Yeah. So Marsh, that's good insight into what's happening in portfolios and how it might impact the economy. What's it impacting, and what are we talking to clients about how to manage this, what's been called the fixed rate cliff on some press?
Yeah, there's a couple of aspects to that. So one is, I guess, a number of clients are now realising the importance of having some of those buffers in place early on to make sure that you've got a disciplined habit of forced savings, so that you've got 3, 6, 9 months worth of savings to fall back on if you've lost a job, if times are tough. We haven't really started to see that at a significant level as yet. I mean, certainly at a client level, mortgage repayments on average, if you are variable, have doubled. Certainly interest rates have gone up, but the commitment that you're paying each and every month has increased substantially. Those clients that are on fixed, clearly, they're sitting at either side of 2%. Variable, it's probably either side of 5% now. So there's a number of clients that will have had 2-year loans that are fixed that are now due to come off. A number still have a 3-year on them. And that's the importance of having that sort of laddered strategy. So at the time we had some exposure to variable, but the long-term debt, either side of 2% seemed very cheap.
Absolutely.
And in hindsight, it certainly is. The interesting thing, Michael, I'd love to know your thoughts around the data as to, with those increased costs that borrowers are currently absorbing, is that from existing savings? Is that from, reducing consumption? Does the data indicate either way?
I'm not across the where the buffer is coming from, and it's also difficult to talk about the average person, because some people are going to be impacted, in a much more extreme way than others, and that's going to create increased pain and could force a sale of their house or whatever. And it's when that starts to happen that it has a knock-on impact to, home prices overall and other borrowers as well. But there is a savings buffer. It's just, and only 1/3 of households has a mortgage, and a lot of those households are ahead. I think I can't remember the statistic, but there's a lot that are 2 years ahead in terms of their interest repayments. And so that's a really positive thing. But that's going to be chewed up, over time. So if interest rates remain higher for a long period of time, that ultimately gets eroded away, and they're facing a difficult thing, particularly if unemployment starts to increase as well.
Yeah, I mean, the other thing that I would flag, even though we've turned this slide mortgage resets, it relates to interest costs. On the other side, if we think about retirees and their portfolios, the income that is landing in their portfolio on average has probably doubled in some sectors, which is going to provide them with a greater income stream. For a number of our clients as well, they will have participated in what was called, effectively the COVID relief mechanism, where their pension payments were halved. Now, for the 1st of July, that halving will be removed. So pension payments will effectively double for a number of our clients from 1 July. So the good news from the retirees' viewpoint is that they've now got greater income levels landing in their portfolio, which should reduce the capital drawdown. Because effectively there was, really a capital cliff for them as well, because at 2 to 3% income, they're going to be drawing 6 or 7% from the portfolio. So we want to try and bridge that gap where we can.
Makes sense.
Turning to the US, there is the good news, I think, which is US corporate balance sheets are actually in pretty reasonable shape. So this is just showing net debt to equity. And that's one of the reasons that US corporates have been able to keep staff employed rather than, large widespread terminations as interest rates have started to rise. Unfortunately, that's not necessarily what the Federal Reserve wants to see. They want to see an uptick in unemployment to curb the inflation rate. But that's one reason corporate balance sheets are pretty good. The other is the starting point for profit margins is also pretty high. So that is, they found it quite difficult to employ people, to find people in the first instance, to train them up after the reopening started to occur in economies. So I think they want to keep those people employed for as long as possible. But it does mean that the Federal Reserve may end up having to go over tighten or go to that 5.5% mark. The other bit of good news is on the right-hand side here, which is that's the maturity profile of US debt. And a lot of companies raised money after the COVID crisis in 2020, and so they don't need to refinance that debt until 25, 26, 27, and it seems to be reasonably spaced out. So there's a window of time over the next couple of years where they don't have to refinance this debt in case credit spreads start to widen and the cost of borrowing starts to widen. But the bad news is on the left-hand side, and that is if you look at bank lending standards, which is the green line on that chart, they've already begun to tighten. So if you think that the entire financial system revolves around credit, the bank's ability to lend to businesses and people impacts spending. And when credit's easily available, this leads to economic growth. And then as a credit contraction begins, that means that spending starts to fall and it leads to higher unemployment and recessions. And at the moment, the percentage of US banks tightening their lending standards has been rising reasonably rapidly. And it's now seen at levels last seen in 2000, 2008, and 2020. And we know that each of those periods was associated with a recession. And if delinquencies of those loans start to increase, banks tighten even further. And it becomes a vicious circle until the central bank eases financial conditions by cutting rates. Now, the odds of a soft landing for the US economy starts to diminish if banks tighten their lending standards. The previous two soft landings for the US economy were in 1994 and 2018. And even though the Fed funds rate was going up during that period of time, US banks maintained pretty easy lending standards. So they didn't choke off credit to the overall economy, which kept things going. That doesn't seem to be the case today. The other thing that is troublesome on this chart is that high yield spreads, which is the compensation you get paid above for a high yield company, a company that has, they used to be called junk bonds to give you an indication of their quality, but they're lower quality companies, and you deserve to get paid an extra interest rate to lend to those companies versus investment grade or higher quality companies. That spread is pretty low today. So that spread's not compensating for an increase in default rates, which is troubling. And then if you look at the investment grade space, this is showing US investment grade yields in the dark blue line, and then it's showing 6-month treasury bills, which are government issued, in the orange line. There's no spread between the two. So you could lend to the government for 6 months and earn the same amount as lending to investment grade corporate in the US, even though they've got balance sheet, fairly reasonable balance sheets today, etc. You are still taking credit risk, and you deserve to be compensated for that risk. Whereas that's not the case at the moment versus T-bills. So just because the environment is reasonable for those companies doesn't make it a good investment because you're not getting compensated for that risk. Mm-hmm. And on this chart, that grey line there just shows the typical spread that you have been paid as an investor to lend to investment grade credit versus T-bills. It has gone to zero before. That was in 2007, and you can see how it blew out quite a long way in 2008 to, but on average, it's been about 3.5%. The next slide, I think, is more relevant and closer to home, at least for us in Sydney. These are Sydney cap rates for property, and this is across office, industrial, and retail property. Cap rates is calculated by dividing net operating income by the property's asset value, and it's expressed as a percentage. It's kind of, like an earnings yield, if you like. And you can see Sydney cap rates have been coming down quite sharply over the last couple of years since 2013. But the other thing that's happened is that bond yields have gone up. So again, we're looking at the difference between what you get in terms of a cap rate versus an Australian government 10-year bond. And today there's virtually no compensation to hold unlisted property versus an Australian government bond. So the only way that cap rates can improve from here is by property prices falling, which is one of the reasons that APRA is looking at the unlisted holdings of some of the superannuation funds and questioning those valuations. The other way is for bond yields to fall. And that means, I think, that those mortgage resets, those interest rate repayments have really bitten into the economy, or that you're able to pass through increases in rental income and you get a higher rental income, but that would have to go up quite a lot. So, you know, the valuers of unlisted properties say that they take an average of the Aussie 10-year bond yield over a 10-year period. But the sharp moves that we've seen over the last year really puts into question, you know, where the valuations are, particularly if bond yields stay high for a long period of time.
So it sounds like you're suggesting that the most likely outcome is that property prices will continue to come off over the next little while.
Yeah, I mean, the three things could happen, but I'd say that it is likely that those asset valuations are under pressure. And I think that investors will probably not want to sell at the moment, but I think the comparable sales will be really interesting to see what those asset prices are.
Yeah, and you've got to think about the demand side of things as well, in terms of have corporates changed their working environment over the last couple of years as a result of COVID? Is there as much demand to take large amounts of office space? As you know, has that altered? Does the demand side have an impact there, Michael?
I would say absolutely. And you know, a lot of the office landlords have really invested quite a bit of money in terms of making the office environment enticing to come back into, and you know, offering people something more than what they get at home, so that they do put up with the 40-minute commute each way, or whatever it happens to be.
Good point.
Then turning to the US equity market, and I'm sorry if these slides are a bit grim, but for a long period of time there, the Fed funds rate was sitting at 0, and the earnings yield on US equities was really attractive. In fact, the valuations of US equities were really attractive too. So the earnings yield is just the opposite of a price earnings multiple. It's earnings divided by the price. And today, there's now a reasonable alternative. Like the Fed funds rate is now nudging up quite close to what the earnings yield on equities is. So for people not wanting to take equity risk, they can sit in cash for a period of time. You know, and that's a big change, I think, in a short period of time for investors to get their head around. 2 years ago, 19 trillion of negative yielding debt. Today, you're getting 5% or thereabouts on cash. You know, it's a big change.
Absolutely.
And then in terms of valuations, and I think it was Jeremy Grantham who said this, which is, if you think about valuations in finance, it's close to the law of gravity for physics, that over time, valuations will come back to fair value. There's this mean reversion pull. And what that means is that valuations are the best guide that anyone has today to what the future return of that asset will be. And so this chart just shows the US Shiller PE, which is a measure of valuations for the US market, and then the subsequent 10-year return on the S&P 500. And at these valuation levels, you typically get paid about 3 to 5% per annum on US equities over the next 10 years. But after inflation, that's closer to 0 to 2% per annum. So that's a lot lower than people would expect to earn in equities, you know, 10% or whatever per annum. But it just goes to show that the market at this point is not that cheap, and it's only about 15% off its highs, which is not that much really. And then there's the risk of buying into an expensive market and then having a sell-off. And this is just showing 3 periods of time in history where there was obviously a major event in financial markets. The Great Depression, the Nifty 50, and then the tech wreck. And it can take a long time to get back the real value of your capital. After the 1929 sell-off, it took 29 years to get back the real value of your capital. That's your inflation as well as your nominal. After the Nifty 50, it took 20 years, and then 15 years after the tech wreck. So, you know, time is not necessarily your friend if you're buying assets which are really expensive. So what do we think about the US market, you know, from this level? Well, if you look at the current, the expected PE on forward earnings and on positive earnings, it's trading at about 20. It's hard to envisage a PE expansion with interest rates still going up. That's going to keep a lid on people really thinking about expanding the PE. And it's also hard to sort of justify this level, given that we're at a fairly mature stage in the cycle. But let's say that the economy ticks along and companies are able to deliver earnings growth of about 9%. What that implies is about a 4,500 on the S&P, and that's the green line there. But if we get an environment where, because interest rates are rising, it puts pressure on earnings and it puts pressure on these PE multiples to derate, it's easy to envisage sort of much lower levels on the S&P. That's what a 20% downside looks like, with an 18 PE and a 10% earnings decline. But typically in a recession, if one was to happen, you would get 20% earnings decline and a derating of the PE to 17. And that would be a pretty high PE during a recessionary period. But that's kind of how we think about the asymmetric risk, the upside risk versus the downside risk of the US market today. And we're very underweight the US market. We're very underweight tech stocks, who also have a fairly, you know, serious headwind with increasing rates. And we're overweight other areas, including Europe and emerging markets ex-China, where, you know, there is similar downside if they have a recession, but you get more upside if they manage to avoid it. What about China? Yeah.
In the interest of time, we've got about 10 minutes to go. So maybe I want to make sure we get to talk about where the portfolio is positioned and that side of things as well. So maybe a quick overview on your thinking on China, and we'll keep going.
Yeah, so on China's reopening, I think, is important for economic growth, at least the expectation of economic growth, because in the last two sell-offs or bear markets, the China stimulus has added about 1.5% to global GDP. But this time around, their reopening also brings aggregate demand back into the picture, which can push up headline inflation in the US. And that obviously has a knock-on effect to basically headline to what the central bank is going to do as well by increasing rates. So it may not be as positive as it's been in the past. Where the stimulus is going today is very much into state-owned enterprises and corporate loans, and it's not going into property market. Mortgages are actually negative. New loans are negative. They're shrinking. And China's big problem last year was that their residential property market was falling. Developers were going bankrupt, and they still need a restructuring of that space, in my opinion. Now, part of that was designed because they wanted to get property prices down and more affordable and reduce the amount of speculation in there. But the problem is it creates a big hole in their economy because the property market adds about 20 to 25% to GDP overall. So it's a huge problem. Skipping forward, I think Hong Kong is a really interesting pressure point in the world at the moment. Back in 1983, the Hong Kong dollar was pegged to the US dollar. It was around the time that negotiations were going on about, handing Hong Kong back to mainland China. There was a crisis of confidence. People weren't accepting the Hong Kong dollar, even in local shops. So they pegged the currency to the US dollar. The issue with a pegged exchange rate is that they basically lose control of monetary policy. They have to import whatever the US is doing in terms of monetary policy. And their domestic situation is very different. They're shrinking. Their economy contracted by about 4% last year. Property prices are off about 16, 17%. And yet interest rates continue to go up for people who are living in Hong Kong. So that's just the wrong policy setting. One way to get out of this is to basically no longer peg the Hong Kong dollar to the US dollar. But at the moment it is pegged, and the HKMA, the Hong Kong Monetary Authority, is obliged to buy Hong Kong dollars when it's trading at the low end of the band. And they've been doing that, but they've exhausted about 83% of their aggregate balance. So now they've only got about $10 billion US left in their aggregate balance, which represents about 1% of the deposit base in Hong Kong banks. So it doesn't take much of depositors to leave to go into US dollars before this would be exhausted. Now, they have other things up their sleeve, but it's one of the areas that people are looking at because it's a very inexpensive hedge for portfolios to go short the Hong Kong dollar. And if the peg breaks, it usually breaks by a long way. So that's something that we've looked at and have in the portfolio too. What does it all mean in terms for investors? A lot really depends on inflation, and that's incredibly difficult to predict. The Federal Reserve has 400 economists, and they've got a woeful track record of predicting inflation. Services inflation can be hard to dislodge without a recession. So that's what everyone's watching quite closely. And, commodity inflation is going to bounce around. The risks of a global recession in the near term have reduced quite a lot, and some of that's been down to luck, warmer weather in Europe. But a no recession environment means that rates stay high and that people have to adjust to a higher cost of capital. And that's going to weigh on valuations of equity markets. We were in an environment where there was no alternative but to buy equities, and now we're in an environment where there are some reasonable alternatives to equities. So Tina's there is no alternative, and Tara is there are reasonable alternatives. And you've got to be wary in this environment of those asset classes that are priced for perfection. In my view, US credit is one of those areas. And I think active management is going to be pretty key going forward. The benchmarks in the past, I talked about $19 trillion of government bonds, at negative yields. They were a big component of the global bond benchmark, and we didn't hold any of them because we're active in assessing those risks. And last year, the MSCI World, which is the global equity benchmark, it had 65% weighting to the US. We were very underweight the US, who were most exposed to rate tightening. So I think active management is going to be really important in managing risks over the next year or two, and safely getting from this point to a new bull market where you can really compound returns and grow wealth. So that's
might be a good point for Marsh to sort of comment a little bit about how we construct portfolios, how portfolios position in relation to benefits and the value of active management.
Yeah, there's probably a couple of different components to that. First, Jeff, I wanted to flag that I think there's been a lot of talk at the macro level right now, but if we bring it down to some of the areas that individual clients can control, your personal economy, which the clients that I work with would have heard me say that over and over, and it's making sure that you're really working with your advisor to have, whether you're an accumulator or a retiree, have all the cash buckets set up and working really well. Outside of that, for accumulators, we want to make sure that, each and every year there will be a calamity of some sort that, the three of us, have effectively been working in markets for either side of 20 years. And every year there will be a reason not to take some course of action. And the reality is that we are still here. So for accumulators, it's really important that you just do the behaviours month in, month out, and allocate more and more of your time to try and increase your personal earnings and either your business interests or the success in the employment field. For retirees, we want to make sure, yes, the cash buckets are working. We've got the asset allocation working correctly so that you're comfortable and you've got that sleep easy factor. But in terms of how we build the portfolios and what the investment committee do, we want to make sure that we've got the right mixture of low-cost index strategies with the right active managers to deliver better outcomes for you. And if I think about over the last 12 months, if we went back 12 months ago, dividend yields within the Australian portfolio probably sat at about 2.6 to 2.8%. That's now changed to either side of 5%. That's because we've changed the mix of managers to deliver greater levels of income to support, the inflation concerns that we have.
Yeah, I think that's I hadn't heard I'd heard of Tina, I hadn't heard of Tara. So, but I think that's a really important part of, a diversified portfolio gives you the opportunity to flex into and out of, within asset classes, across asset classes, and rebalancing, because there are some alternatives now. So, certainly fixed income, as you've touched on a few times, Michael, presenting some opportunities. Active management of equities being, you don't have to buy the whole country of the US, but there may be businesses within the US that you're going to do well over the next period of time because they're favourable conditions for what their way they're operating, and that's where our managers are really working hard to identify those opportunities.
Correct.
While we pay them the big bucks to go and do that as well.
Yeah, I mean, the other thing I would flag as well, Jeff, is that we've been working with Michael's team for a number of years now, and for accumulated clients, just so that you had some understanding, typically each of our accumulated clients, Michael and his team will manage about 10% of their portfolios. And for retirees, it will be anywhere from 15 to 20%. So when you look at the portfolio valuation, if you see a reference to the Perpetual Diversified Real Return Fund, that's where Michael and his team are making these tactical decisions that they can do each and every day. The decisions that you make with your advisor are far more strategic in nature. The decisions that I make along with my peers sitting on the investment committee are not typically day-to-day tactical in nature. From time to time, there might be something that we observe that we can take and pursue opportunistically, but typically we rely upon Michael and his team to do that because they've got access to far more data and can respond more efficiently than we can.
Absolutely. So we've pretty much come up to our allotted time, but I just wanted to give an opportunity if anyone has any questions to, I think most of the questions we've had have been answered on the way through, which is great. But if there's any questions, otherwise, Michael, if you want to touch on briefly, I know you've got some slides here on how the portfolio is positioned and the fund specifically. Happy for you to spend a couple of minutes on that. We'll also share these slides, will be sent out with the link to the recording. So if you have questions as you go through that, come back to us on those as well, but maybe a couple of minutes on the fund itself.
So the Diversified Real Return Fund, which is a part of your portfolios, one of the major differentiating features is that every investment decision that we make for the fund links back to the objective. We don't have to hold any asset class within the portfolio if we think that the risks outweigh the potential for return. And the questions we ask ourselves are, what types of investments will protect the portfolio from an inflation shock, which has been really important recently? What has a high probability of achieving an inflation plus 5% per annum outcome? And there we're looking for valuations to be very much on our side because that gives us the highest probability of achieving that target. And then we're looking to build in genuine diversification, things that are uncorrelated or move in a different way to equities. And there we can go active in currencies and also have stock selection alpha, which is uncorrelated to the equity markets. And then the final point is to protect the portfolio from years like last year. We can use fixed income in that portfolio, but as I mentioned before, we had zero fixed income for a large part of 21 and 22. And that was important because fixed income was one of the more expensive asset classes. So we used other downside protection techniques to really protect on the downside. So just moving through, over the 1 year period, the fund was basically flat for the year, delivering a zero return, but it compared really favourably to alternatives such as the typical conservative fund, which had 70% in fixed income and cash and 30% in equities. Those funds on average, at least according to the Mercer survey, were down about 7.3%. And the volatility, the risk that was taken to deliver that was 7.2% for the typical conservative fund, whereas the real return fund did that at about half the risk. So we're trying to get that balance right between generating returns and managing the risk in any given year. But over time, the fund has delivered close to a CPI plus 4 outcome. That's shy of its CPI plus 5 target, which is what we're trying to achieve. It has had a couple of periods such as the sell-off in 2020, which did well in, but which have impacted sort of us achieving that target. But in order to get closer to a CPI plus 5 outcome, investors would have had to have been in something like 100% equities to get that outcome. And that's 4 times the risk of where the real return fund is at. The dark blue line shows how the fund has performed in down markets over, since 2010. And so you can see that over time, it's had pretty good downside protection qualities, and it has had fewer and shallower drawdowns than certainly equity markets, which delivered that CPI plus 5 outcome, but also bond markets in recent period, and the Oz Comp bond index, which includes credit, had a very difficult year last year. Risk-adjusted returns are really important to us, and that is, how much risk is required to generate a return. And we measure our funds and compare them against others in the survey by just taking the return and dividing it by the risk that was taken. And across each of these categories, the funds have done really well. And I think that's the right balance for clients, that you want to be rewarded for the risks that you're taking. And then in terms of current positioning, and this will be the final slide, I think, Jeff, this is where the fund is positioned at the end of December, and compared to a year ago. And then the dark blue bars on the right-hand side is the maximum allocation that we can have in any of those asset classes. So we are conservatively positioned in equities, and within global shares, we are underweight the US in favour of other markets. We are underweight Australian shares and listed property as well. And that's obvious for reasons that we talked in the macro outlook. And we, in the fixed income space, we've added back duration or fixed income into the portfolio, but we are significant. We held nothing in US credit, which I think is, picking up pennies in front of a steamroller, essentially. And cash for the first time, we're significant allocation, which is very low risk and earning a yield for the first time in many, many years. But the key to this is that if opportunities present themselves with market sell-offs and valuations become a lot cheaper, and if central banks, rather than tightening liquidity, start to ease monetary conditions again, we can increase the risk of this portfolio quite a lot. And that's where I think the heavy lifting for this portfolio will be really done in achieving a inflation plus outcome.
Fantastic. That's great. I think it's a good place to finish, showing, bringing it all together in terms of the ability to be really broadly diversified and, as Marsh said well earlier, quite tactical in terms of how you manage the client's money, which is great. Thank you very much for your time, Michael. Thanks to you and your team for the great work you've done for our clients and for your insights today. For everybody at home, thank you for playing along at home. If you have any questions, this recording will be sent out. Please come back to us or your advisor with any questions, and we'll be happy to answer those. But have a great day. Thanks, Michael.
Thanks a lot. Thanks for the opportunity.
Thanks, Michael.
Bye.